Welcome to Blue Chip Now, the podcast that gives you insider access to content that we tailor specifically for our clients. Whether you're climbing the corporate ladder or just seeking smart, efficient intel, we've got the answers to your most pressing financial questions. Join us as we break down the markets, debunk the headlines, and keep you ahead of the curve. Let's dive in. Welcome back to another episode of Blue Chip Now. You have Daniel Dusina, Matt Mondoux, and Dan Seder. So we're getting to the point of the year where we start to get predictions that come out. So the sell side, call it the research folks on Wall Street, will put out price targets for the S&P 500, economic outlooks, specific sector outlooks. But I want to specifically kind of highlight the fact that sell side price targets for something like the S&P 500, I don't have the data in front of me, but they're very rarely correct. And kind of just case in point, going into a really challenging year like 2022, Wall Street was, no surprise, very, very optimistic about price targets. I find it very interesting that right now, with the S&P 500 kind of hovering around 6,000, that there is almost a unanimous consensus around a price target of close to 7,000. So pretty optimistic. Whether that's right or wrong, we're not here to debate that today. But instead of putting out predictions for 2025, which in our opinion could be rather fruitless, we want to talk about some expectations. Expectations by way of portfolios, by way of economic trends. Realistically, we just want to step back and try to put some meat on the bone instead of throwing out, targets that may or may not come to fruition.
Half step back on those targets. Isn't there also a certain amount of career risk from an analyst perspective? The Morgan Stanley guy.
Yeah, Mark Wilson. I was glad you brought that up.
Okay.
2023, calling for a 20% decline in Q1 of 23.
Right. And he was hugely wrong, but isn't it really, really difficult going into 2025 after the market is absolutely ripped to be the guy saying anything from a bearish tone? And if the market continues to climb, again, there's career risk because the perma bears on Wall Street who were wrong are now fired and at different organizations.
Well, yeah, and it's like there's so many other factors at play too. This is getting into the weeds a little too much, but the guy at Morgan Stanley or the guy at Goldman, you need to think about how what he is saying can impact some of the firm's other clientele, right? So there's a weird game that's played, and it's convoluted, but
it's important when people hear these things. They often think, "Wow, Mark Wilson's really bearish. He must be in 100% cash." And that is so far from the truth. When these organizations, portfolio managers, are managing to benchmarks, their underweight U.S. stocks could be 4%. So they could have a target allocation of 70, and they're at 66% U.S. stocks, even though they're bearish. It's so tough to really take anything away from that, because I think when readers digest that information, they're thinking, wow, it's time to get out of stocks. And these organizations are far from doing that.
Time frame matters too. That's the other thing. I'm bearish. Well, based on what time frame? I always use that example. You could pull up two analysts that one would say buy company ABC. The other one would say sell company ABC, and they could both be right, just right on different time frames. So time frame matters, and there's so much behind the headline recommendation that you see an analyst giving that really doesn't tell the full story.
And so I guess that's more or less what we're going to try to do today is put some thoughts around our expectations that can be a little bit more tangible and less about just picking a specific number. I don't know what direction you guys want to start with, but I mean, we can go, I guess, broad economic expectations. We can start with portfolio expectations. Do you guys have a preference?
Yeah, let's start big picture. Maybe why don't we start, I'll tee up the discussion. A lot of clients are now asking, hey, because the stock market has run up so much, is there an inevitable pullback? And or when does the inevitable pullback happen? And my comment is first and foremost, let's look at some fundamentals. Let's look at valuations. Is the stock market overvalued at its current state? Any comments there on how the market's valued?
So you can look at a number of different things, but what I'm going to pull up on the screen right now is just showing in blue a very simple price to earnings ratio for the S&P 500 index going back to 2014, I believe.
So the price of the S&P divided by the earnings of the S&P, price to earnings ratio, which is a valuation metric.
Right.
Is a market like the S&P overvalued or undervalued based on this metric?
Yeah, and I think to put it in context, it's important to kind of understand, okay, when this valuation metric, the price to earnings multiple for the S&P 500 is rising, that generally is going to mean that the price that an investor is willing to pay for a share of this index, not like you can buy the index, but bear with me, the price that someone's willing to pay is appreciating faster than the earnings that the companies within that index are generating. Yeah. So that's general optimism. But I guess what you would like to see, and instead of terming something as overvalued or undervalued, this kind of gets into like the price target conversation. When is the S&P 500 overvalued? Is it at 25 handle on PE? Is it 22? To me, it's when earnings are stagnating and the PE multiple is still expanding. So investors are still bidding up stocks without consummate earnings growth. That to me is something that's more realistic in terms of terming an index or a security or a market overvalued. So what we have right now, and this has very much been the case for the last 2 calendar years at this point, you've had earnings growth coming off of a bottom in 2022.
I mean, pretty significant earnings growth,
earnings growth.
Meaningful.
Absolutely. Each of the last 2 years. Now, having said that, the S&P 500 has gotten more expensive by way of this PE multiple because the price of that index has appreciated faster than earnings have grown. So even with earnings growth that has been in high single digits to low double digits each of the last 2 years, you're getting a valuation metric that gets further and further stretched. Now, does that mean the market's overvalued? I don't think inherently so, because if you do get continued earnings growth, you have companies that are able to generate revenue and translate that revenue into actual profitability on a continued basis, then the market's supported and investors are optimistic because companies are continued to be productive.
So earnings continue to go up and hopefully the earnings can match or catch up to that movement in price. Yeah. But let's talk about a situation where maybe price moves. A way for that valuation metric to correct itself is price can come down. Another option or a scenario that I talk about with clients is prices in the stock market don't need to crash. They don't need to correct. They could consolidate sideways. Another way for the stock market to digest a big move up, which is what we've experienced in 2024, is a sideways consolidation where things muddle along sideways for price while the earnings, which is the denominator in that price to earnings ratio, while earnings catch up. So there's also an environment where a sideways movement in stocks is the way for the stock market to digest the big move that we've experienced up over the last couple of years.
The other thing that, when we just look at PE in isolation too, and this is really difficult, right? But in an extreme example, the market today has much more in technology stocks than the market of the 1980s, right? So to compare historical PEs of compositions of markets that have just different business types is really difficult. And one of the reasons why you do see an elevated PE now is because of the weight towards technology. And I would almost argue comparing the PE today to a PE 20 years ago is almost irrelevant.
Or the historical. What's the historical PE? 16?
Right, which is weighted down by industrial companies from the 80s.
From 50 years ago.
Because
no sense.
Because and that's important also. When we have higher PEs, generally that's accepted when margins are higher. So profit margins being higher. Technology companies generally have higher profit margins than, let's say, GM or an auto company. Yeah. So all these things fold into the story. And it's not just as simple as saying, is the market expensive on a PE basis, but why?
Yeah.
All right. So I think we can all agree, just so we don't spend too much time on valuation, we can all agree that the price movement has been meaningful. There's an environment where earnings can catch up. There's an environment where stocks can slightly pull back or stocks can go sideways. Yeah. We don't have the crystal ball. We don't necessarily know, but it doesn't simply mean because price has gone up, price has to come crashing down. There's a justification for these price movements in the form of fundamental earnings.
Yeah, I think that's fair, right? And we have no expectation for that to meaningfully change next year.
So let's talk sentiment. What about how investors are feeling? Any thoughts on sentiment?
I mean, just looking at the data, we like to look at a few different measures for sentiment. We've talked about the AAII sentiment survey. We've talked about CNN's fear and greed index. Whatever you use, it really doesn't matter. But sentiment is, as we've talked about in this forum and elsewhere at Blue Chip, a very powerful indicator, and not always for the reasons that some of the listeners would think. Generally speaking, when investors are broadly incredibly optimistic, that's usually a good precursor to a bit of a pullback, and just vice versa, right? When investors are overly bearish or overly pessimistic, that's the time when I'm starting to get interested in putting some more chips on the table.
So said another way, sentiment is a great contrarian indicator.
Yeah.
So when it's at extremes, if there's extreme bullishness, that it goes back to Warren Buffett saying, be fearful when others are greedy and greedy when others are fearful.
And let's be clear too. So when we say extreme, this extreme levels don't even happen every year, right? It may be multiple years before we see an extreme level that really truly rises to a contrarian indicator. So I always like to say sentiment's great. 95% of the time it does not help. But the 5% of the time it does help, it's extraordinarily powerful. There's probably no better indicator.
Are we in an environment where sentiment's at extremes?
I'm not going to spoil the answer, but if you guys, I'll take a step back. But so when Matt's talking about these extremes, so for something like the AAII sentiment survey, that could be the percentage of respondents saying they're bullish being 55%, and those saying they're bearish is 15%. So that spread between being north of 30, 35, that's a really, really, really large number for us to see on a survey like this. If I was going to ask you guys, and I'm not even going to ask it hypothetically, I'm going to ask you guys, when do you think the largest percentage of respondents said they were bullish on this AAII survey this year? Like over the last year, when do you think people were the most bullish?
The first week of November.
And I'm obviously looking at the chart, so I'm cheating. So I'm going to refrain because I do know, but go ahead.
Well, yeah, so the audience can see this, but it was actually at the very beginning of this year. I mean, technically it was the very end of last year. So
January. Okay.
December 20th of 2023.
That's amazing. So it's not even during those massive spikes or rallies.
Right. It wasn't. And again, like to the whole point on like the contrarian nature of these indicators, or at least like how we can use them, it's almost like it's no surprise that that wasn't when the most people were bullish. But it also isn't surprising to me to see this because, you know, if you look back at what was going on in the market at that time, I mean, it was kind of going gangbusters to round out the year. So again, like it's a bit of a trailing indicator. Sentiment right now is not at extremes. It's leaning bullish, but it's more or less fairly balanced. You have about an 18% spread between those bullish and those bearish as of last Wednesday, I believe. So to me, there's nothing wrong with a bullish or bearish skew. It gets more interesting when you get those extremes and when you get those extremes for a consistent number of weeks.
Makes sense. How about, should we go into the economy?
Sure. Yeah.
I think there's a few items that we've talked about as a group, which can relate back to inflation. We can talk about jobs. We can talk about consumer spending. Where do you want to start?
We'll just start with inflation. I mean, you could call this the word of the year from 2022, probably. I mean, I'm not going to sit here and say that it's a non-factor for 2025 because I do expect it to be somewhat of a factor, just given some potential changes in Washington.
Policy, tariffs, whatever it might be.
Yeah, but at the end of the day, I think the Federal Reserve has more or less done a good job of managing the general level of price appreciation in the economy. And, we've gotten to a point where consumers have been able to digest the level of inflation. And I actually think we've found somewhat of a middling bottom here on inflationary measures, whether you look at the consumer price index or personal consumption expenditures, which I'm showing on the screen right now. Those both show essentially the same thing, just calculated a little bit differently. But, we're running at about, 2.5, 2.75% year over year price increases. It's above what the Federal Reserve target is or what the generally expected kind of level is. But, realistically, I think the trajectory that we've seen over the last year and a half, 2 years as being coming back down to earth, really that's kind of all we can ask for right now. And we've found a balance at a level that, again, consumers would not be spending at the level that they are if it wasn't palatable.
So this is controversial, the question, and answer, it doesn't matter how you answer, but I'm curious both of your thoughts. Powell at many points over the last couple of years has talked about inflation being transitory, meaning it's going to come, it's going to go. When you look back at the chart on inflation, was it transitory?
I think it's really hard to say that. When you look at that chart, it's kind of like, in hindsight, how could you miss that, right? Like, you just came out of this period where you pumped a ton of dough into the economy. People were staying home and spending money like crazy on random stuff. Supply chains were throttled. How did you not see this coming, right? That's in perfect hindsight. But in reality, we have never really been through anything like that before, right? Like, I think that's where I want to give him the benefit of the doubt, because that was a pretty ridiculous experience that we went through. And, if I'm being completely honest, like, living through the last 15 years of trying just to get to 2% inflation, yeah, I would have no reason to believe that we would consistently be above 3, let alone above 8 for a period of time.
Well,
right?
What do you think, Matt?
Yeah, so parts of it were transitory, right? Used auto prices. There was a time when used auto prices were a massive driver of inflation. No pun intended. Lumber. People remember lumber spiking in early COVID. There were a bunch of individual segments that contribute to CPI that were absolutely transitory.
Yeah.
Now, the big one that isn't and has not been has been housing. So housing's been the tough nut to crack for the Fed, because high rates have people locked into their house at lower rates. We have an inventory problem. Prices are not coming down. And, Daniel, as you've highlighted, that's the biggest contributor to inflation. It's been shelter. Mm-hmm. So I would say, 50% of the CPI calc, absolutely transitory, but this massive other 50% or a third is not. And there's no easy way or no easy solution other than building inventory, which, for obvious reasons, home builders are more reluctant to do.
So I'll generalize here in saying that inflation is somewhat under control. It hasn't flared up. The spike has been tampered, and we're not in an environment, at least at this point, TBD where 2025 goes, but inflation is relatively under control. Maybe not at Fed targets, but it's close.
Yeah. Well, and like I said, kind of at the onset, if what leads me to say that it is in a reasonably good spot is that, look, if prices were overly cumbersome for the average consumer, then you would not see consumer spending contributing to GDP. Yeah. And instead, what I'm showing on the chart right now is quite literally just the consumer spending piece of U.S. gross domestic product, which is basically just U.S. economic growth. And consumer spending on average constitutes 2/3 to 3/4 of that. So for the last 3 years to be running on average, plus 2% and more. Even this year, we're kind of running at like 3% per quarter on a seasonally adjusted annual rate. That's just not an environment where prices are prohibitive, right? And that should be taken as a positive sign for not just the consumer, but more so for just the business operating environment.
You see it in price. Consumer discretionary stocks relative to more defensive areas like consumer staples, consumer discretionary on a relative basis has been blowing up, all-time highs.
And I would say that the one thing I think the expectation or economics 101 will kind of lead you to believe that I just don't see prices coming down right anytime soon. I mean, the economy is strong enough that it's going to support the current level of price. Doesn't mean we continually get these increases, which I define, sustained inflation as a year over year phenomenon. And what you could see from the chart that you had posted earlier was that we had that blip from the demand side during COVID, and we just don't have that anymore. It's really worked itself off.
And so the consumer spends why? The consumer spends because they're employed.
Yeah.
So labor has been relatively strong. I know labor has weakened to a certain degree, but overall unemployment rates are still, I don't know, could you say historic lows?
Still.
But they're close.
Yeah.
They might not be at all-time lows, but they're pretty darn low.
Yeah. Yeah. And I think that, coming into this year, we talked a lot about that side of the equation because, it was for a long period of time, the whole inflation situation that was the focal point of many economic conversations, the focal point of the Federal Reserve. But to me, coming into this year, it was like, okay, let's take a pulse on the labor market. We started to see some cracks, and we definitely have seen a bit of a slowdown this year. Now, again, I will caveat that by saying a slowdown off of really strong month-over-month job additions is not inherently a bad thing. It's getting back into balance. I do think you're going to see a somewhat of a continuation of this kind of coming back down to earth. So if you look at the chart that I have on the screen, it's showing non-farm payrolls month over month. That's just new jobs added in the economy each month. And over the last few months, we're kind of finding an average of, call it 150,000 a month or so. And you can see the chart, there's a clear downtrend, but that's not unexpected as people kind of return to the office, return to work. There was a lot of weird things happening within the labor market that were skewing these pieces of data. But now as you kind of develop this longer term trend and you are able to zoom out and look at this 3-year period, I think what you're finding is that the labor market has started to find, again, like inflation, find somewhat of a bottom. And it seems to be one that's fairly comfortable, absent some blips that we got, over the last month or two with some really odd stuff that was happening. Mm-hmm. So long story short, I think we're in a pretty good spot. I'm not going to sit here and call it like a Goldilocks environment, but I do think that we've started to see a lot of shakeout happen. And where the dust is settling is one of relatively low unemployment, relatively, I would say, consistent consumer spending and manageable inflation. That to me is a pretty good operating environment for corporations.
We have sell-side analysts on one side, extreme bullishness. I'm feeling a lot of sentiment from our clients and prospective clients in terms of bearishness, only because the market's up, it has to come back down. What goes up must come down. The way it plays out is likely somewhere in the middle. We don't really know. We don't have a crystal ball. What do we know? We have to help our clients build, execute, navigate financial plans. Is it important to identify a 12-month price target and get it right? Probably not. It's probably more effective to build a financial plan, operate that financial plan, be tax efficient, understand how your estate is set up, all the things that we do with clients, right? That make a big impact and navigate the markets along the way. And we take what we get from the markets and we make the best decisions. But really at the end of the day, focus on the financial plan. Let the plan drive the portfolio. Let the data that comes in from the economy or from the markets, let that drive decisions in the moment.
Yeah, because we have a sell side year-end target on the S&P doesn't mean we're going to get there in a linear fashion. It's going to be a smooth ride.
Yeah,
right.
Never.
It never is. So those are really, to me,
and I've seen
worthless.
I've seen so many of those predictions in the past, and I can't remember what year it was, but it was classic. We had the top 20 strategists on Wall Street that ranked in order the performance expectations for each sector, and not a single analyst in this particular year that I'm referencing had utilities at the top. In fact, they all had utilities at the bottom, and utilities were the number one performer that year. Yeah. So it's that kind of thing that happens. So I don't know, just thoughts on what my final comments were.
No, I think that's great. And like I said, we deal with expectations. We expect the companies to raise dividends. We expect diversification to help. We expect there to be 5 or 10% corrections. We build portfolios, diversified portfolios, in the event of there being some type of normal pullback. Yeah. Geopolitical risk. We're always we create a portfolio with those thoughts in mind.
At the end of the day, what I was trying to say is it's not about throwing out a prediction and that prediction being right or wrong. There's so much more under the hood.
Right, exactly. And and what I would expect is that market timing is not going to be the best strategy of the year. Yeah. So why try?
Yeah. I think we covered it all.
Cool.
Yeah. Well, I thought that was a productive discussion. Hopefully the audience enjoyed it as well. I don't know. I like stepping back and talking about realistic expectations instead of, we could sit here and guess at which sector is going to provide the best return next year. But quite frankly, I just don't think that's going to be in anyone's best interest. So,
any Super Bowl predictions before where the Lions going to fall this year?
I can't even.
Injuries.
Can't say it.
So I expect them to make the playoffs. Yeah. But that's I back 10 years ago you would have predicted them to make the playoffs, and now I think the expectation is playoffs. Yeah, so. It's a good spot to be.
Yeah. Positive momentum.
Expecting a fun season. Yeah. Well, as always, thank you so much for tuning in and listening to another episode of Blue Chip Now. Please head on to our YouTube channel, Blue Chip FM. Check out some of our recent podcasts. Share with a friend. Watch the video. See our smiling faces. And until then, see you next time.
Thanks.